The economy and housing market are in for a ride this year as the Federal Reserve predicted interest rate cuts in 2024. New projections with 3 cuts in interest rates down to a federal funds rate of 4.6 has made the market go off the deep end. The situation right now is not going to end well, with long-term yields and mortgage rates going down and the stock market surging. Why? The Federal Reserve interest rate cuts bring quite the downfall as it directly affects unemployment rates, causing a spike. It's nothing new since we saw this exact scenario in 2007. Let's go back in time. What happened? The Fed cut interest rates in September 2007, and this initial rate cut caused stock surges, making Dow Jones Industrial to jump 2.5%, the S&P to gain 3%, and the Russell 2000 to gain 4%. Well, that doesn't sound that bad, does it? That's exactly what these companies were reassured of at the time as well, when the unemployment spike occurred only a year after this interest rate cut. With the recession, even big corporations like Lehman Brothers went bankrupt. This false reassurance of the current economy clearly resembles this past scenario we've seen just 15 to 16 years ago. If you say that the exact same thing won't happen to the economy this time, well, it's true. If the stock prices and home prices keep rising, most likely there would be a safe landing in 2024. But how far can we expect to be this optimistic? Right now, the data is looking real bad, with the US consumer having an average savings rate of 3.8%, and while going through the biggest debt load the US economy has ever experienced. Total debt in America has reached $73 trillion between the US government, consumer households, and corporations, and it's now at 265 of GDP. It can be guaranteed that we are not in a safe place to be so optimistic. It won't matter if the federal interest rate cut is by 3 times or by 6. People and businesses will senselessly and carelessly refinance the debt at higher interest rates. This will eventually tighten the rope around the economic activities, killing off the economy. This graph shows the federal funds rate in America since 35 years back or so, to 1990. The Fed could not stop the Great Recession in 2007, even though they cut the interest rates to 0%. Now, the Fed has pushed the interest rates up to 5.3% from its previous 0 level and maintained that ever since August 2023. The blue line at the end indicates what the betting markets are projecting. The betting markets predict that the Fed will cut the short-term interest rate down to 3.8%, but that's not the case. The Fed thinks of cutting down by only up to 4.6%. However, by the end of 2024, the short-term interest rate will be above the 0% level, and also above the long-term average for interest rates that lasted 35 years. What does this mean? It means interest rates are still going to feel high, but the real case is that they're not. The interest rate cut is not high compared to the 1980s, but it is high when considered with the amount of debt existing in the economy. With all of this, the rising question is, what will happen to the housing market? With the interest rate cuts, the mortgage fees will follow suit. Mortgage News Daily reports that the 30-year fixed rate has already dropped from 8% to 6.6%. That was from mid-October to mid-December. This drop by 140 basis points is considered to be the biggest 2-day drop in mortgage rates in decades. Realtors are finding this scene quite beneficial and even considering buying properties right away. But here's the reality behind rate cuts. Even though the mortgage rates go down, it does nothing for affordability. Say mortgage rates will go down all the way to 5.7%. It would lower the monthly payment from $2,800 to $2,400 a month. And you can call that an improvement, but here's the issue. This improvement is not really an improvement, but a mere return to the state we were in late August to September 2022. It only returns the monthly payment to 80% higher than it was prior to the pandemic. When compared to the income level, this is a very high payment, and keep in mind that people are still struggling from the inflation of the last 3 years. A speculation is that buyer demand won't come back as fast as we anticipate, since people can't seem to afford things, the savings rate being 3.8%, and the wages have not gone up as fast as the housing prices and mortgage rates have gone up. Therefore, even if there is a buyer demand, it can't be expected to be that strong. The responses to this question proves the point, as only 24% has said yes to buying a new house in this condition, while 76% said no. There will be more buyers next year, but not as much as you'd think. I believe home prices will go down in 2024, which will not only attract buyers, but sellers as well. And surely it won't be the biggest surprise if you see the rise in new listings in inventory, with the lower interest rates due to the Fed rate cuts. This will not come in handy for the well-being of the housing market though. Big realtors like Compass, Zillow, and Redfin are actually expecting these challenges in the upcoming year as well. So keep an eye out for buyer demands along with new listings and inventory. The main question right now is, where are the home prices heading in your market in 2024? This cannot be predicted for sure, but sale inventory deficit metric can. This metric is designed to find how low or high inventory is in your housing market compared to the long-term average. If we consider states like Texas, Utah, Colorado, and Tennessee, they have a surplus in inventory. What happens with the surplus of inventory? Well, if surplus is high, probability is that prices will go down, and vice versa. In Illinois, sale inventory deficit's 40%, which means homes for sale on the market are 47% lower than the long-term average. Similarly, in New Jersey, the deficit is 52%. In Connecticut, the deficit is 60%. You can check out more information on this yourself using the Reventure app for just $39 a month, and you can cancel at any time. There's even more to this information if you break it down in zip codes. Take Dallas for a moment. There are certain zip codes that are not shown in red, which has double its inventory from average and other neighborhoods in the north like Frisco, which is 38% down from normal. In other words, Frisco should have 150 houses on sale, but there are actually only 95. Whereas in Princeton, north of Texas, inventory is higher than normal, which means prices are more likely to go down. With this information, you can see that there are contrasting price differences depending on the place. To be sure that you're not making a huge mistake, it's not just important to know the nation's or your state's or even your metro's housing market. You need to know the trends in your zip code. To conclude this, let me tell you again. It is important to keep an eye out for the macro developments because obviously lower mortgage rates are going to have an impact. New buyers will come back to the market, and so will new listings. These are going to impact the housing market so hard. This year will be quite reactive, with prices going up in some markets and down in others. So, to make it easier for you to track the next 12 months and look at the data, make sure you subscribe to the Reventure app to search for your city or zip code and look at what inventory trends are. Mostly in the sale inventory deficit, which is a premium data point you can have access to just for $39 a month. Thank you guys for watching. As always, please make sure to hit that like and subscribe button if you enjoyed it.